Hi, this is Linda Hitt. We're going to take a look at depreciation methods for long-term tangible assets. Except for land, most of your property, plant, equipment items do need to be expensed over time. They do get used up and they have to be replaced, whether it's wear and tear or obsolescence. Most things don't last forever, unfortunately. So what are the variables for depreciation? How do we decide to do it? Because you hear that term in a lot of ways. For accounting purposes, depreciation is simply taking your historical cost, the price you paid for it, and spreading it out over some period of time. Unfortunately for us, of the three things that we need to know, only one are we certain about, which is the historical cost. So we would estimate what the item will sell for at the end of its useful life. That's, again, an estimate. And then the useful life itself is certainly an estimate. We don't know. The time may come and the asset's doing well and we don't have the money to replace it. We may keep it. So it will not be a perfect matching, but we are trying to match. We're trying to look at the cost of using up the asset as we generate revenue from it. And you can't look at a piece of equipment and tell how much has been used up. It's not like insurance where you can look at expired insurance or count the supplies. There's no quick and easy way, so we come up with sort of a rational, systematic process to figure this out. It may not seem so rational the first time around, but we do the best we can. So the most you ever can depreciate is the price you paid for it, less what you think it will sell at the end. And if you're not sure what the salvage value or estimated selling price will be at the end, you can just simply make that zero. So we do the best we can. Approaches that we have, and certainly may be others, but these are part of the U.S. generally accepted accounting principles. The most highly used is a time-based method we call straight line. As the name implies, if you draw it on a graph, it's a straight line. If you purchase the asset at the beginning of the first period and first month of your first year, if you're doing yearly depreciation. So every year you charge the same amount of depreciation. Most companies use this, or many companies use this. You can see the formula is pretty straightforward. It's just the price you paid for it, less what you think it's going to sell for, divided by the length of time in months or years that you plan to keep it. And this is management policy, what the useful life is. Your car could last 10 years, but maybe management's going to trade it off in 3 years, so that's going to dictate. This is a great method. It's easy to understand, but it may not be the best method for all different types of assets. But with the U.S. rules, you can use it for any asset. There's no restrictions. But if you have something that becomes obsolete, like computer or high-tech type things, then maybe another method would be better, like the double declining balance, which we'll take a look at here in a sec. So straight line is probably, again, up there as the most used method. And based on time. Double declining balance, and there's other 1.5 times declining balance. There's other variations of this. But basically, this is the one to use if you have a lot of obsolescence, or you have a lot of wear and tear in the early years, or you drive that new car off a lot and all of a sudden it drops in value. For many reasons, you can consider this one. It has good points and bad points, just like the straight line, though I'll admit straight line probably has the most good points. The formula is very different. If you look at it, historical cost looks familiar, but it's a historical cost less accumulated depreciation times 2 over the useful life. Or another way of saying it, it's the book value at that point in time times 2 over the useful life. You'll notice that salvage value is not there. Oh my gosh, if it doesn't have salvage value, how the heck does it know when to stop depreciating? So the amount's not going to work out, and companies sort of fudge this by kind of using a straight line approach when you get close to the end of a useful life. So for whatever reason, this method caught on, and there is something called sum of the year's digits, which also has a declining amount each year, but it doesn't have as high of depreciation taken the first year. For whatever reason, that one didn't catch on. This is the one we've got. So take it for what it's worth. It's got issues too. And then if you don't like time-based methods, there's another one we can use, which is called units of output. That one expresses useful life in something other than time. So, and I I don't know how you would use this for a building. There may be some assets it's just not really going to fit, but it could work for a car because you could use mileage. Maybe an airplane, you could use hours flown. A copy center, you might use number of copies produced. Manufacturing, the number of widgets that you're making. So it fits nicely with some assets, but honestly, if your usage is about the same each year, use straight line. That's easier. But if your usage varies, say like 1 year you have a lot of revenue and you've really worn out that equipment or whatever it is, it kind of makes sense in those years to have a lot of depreciation expense. So it probably does a better job of matching with uneven usage, but it's more work. So the trouble is you've got to now track the amount of usage that you make. In the other methods, you didn't have to do that, but we got to keep track of the number of miles we drove the car, number of hours for the airplane, etc. So you have to decide, is it worth that? So let's go ahead and take a look at our example and do some number crunching, which you all are good at. And so we're going to basically purchase a car and do some entries because we're going to look at expenses again as well as depreciation. And we're going to go through 3 years. We'll track for 2 years 3 different methods. And we can look at the impact on the statements. We'll try to show our calculations. And then over here we're going to kind of track cumulative. What do we have on the income statement for the 3 years? And we're just going to do, I guess, straight line, for the income statement. But for the balance sheet, we can track how does the book value differ with your 3 different depreciation methods. Okay, so we purchased the car. Let's do the easy one first. And the information about the number of years we're going to keep it, you don't have to worry about that until you actually depreciate it. Sorry, it's allergy time. Okay, so here's the purchase of the car. As we know already, that's going to be an asset exchange. And we also know the cash flow for property, plant, and equipment would be investing. Okay, so we just get it on the books. And I guess I'm just tracking the depreciation cumulative, so we're not going to actually post all the entries. So next we pay for gas. Okay, I think most of us would recognize this. I'm just going to put it as an expense. You might track it as gas expense, car expense, miscellaneous expense, whatever you want. Knowing that you need the most detail to make all your decisions, set up your chart of accounts accordingly. So you've used up an asset, expenses cause stockholders' equity to go down, profits are less, and for cash flow purposes, this would be operating. Cash paid for any expense. Next we have prepaid insurance. We went ahead and paid it for 3 years. So clearly we need an asset account. So prepaid insurance, and we're lowering cash. Again, it's no surprise, this is another asset exchange. And this has a lot of asset exchanges going on. Whoops. And for cash flow purposes, prepaids are operating. Okay, buying seat covers, some type of expense. Not important enough, not large enough in amount, just an accessory. Okay, so paying for expenses, and hopefully you're seeing the patterns here. You're using up assets. Retained earnings goes down because of the expense. We have less profit, and we have a cash outflow. So we can see why sometimes people are trying to avoid recording expenses. It has a big impact on the statements. Okay, end of the year comes and we're adjusting, and this is the major part of this video clip. We want to expense a full year of activity. If we look at the top, it's either a 6-year life or it's 180,000 miles, depending on the method you're using. So let's start with straight line first, and the salvage is 2. Your cost is $20,000. Salvage value, again, and you're always given that in problems, divided by the useful life. If we're doing it by year, then we could divide by years. If you're doing it a monthly statement, then you could set it up as per month. So if we simply do the calculation for this, it's cost minus salvage. Okay, and oops, I took an extra 0. I guess I need to do that again. So it's cost minus salvage. Okay, $18,000 is the most I can depreciate over the life of the asset. That's what we call depreciable cost. And then I'm going to divide it by 6 years. And we did buy it on January 1st. If you buy it between the 1st and the 15th, first half of the month, you depreciate for the full period. If I were to purchase it at the end of January, between the 16th and 31st, then I would have depreciated only 11 months for this year. Okay, so I come up with 3,000, which hopefully is correct. Let's put it here, equals 3. Whoops, didn't like what I did, of course. Got an extra symbol there. So it's $3,000. Okay, so the entry is pretty straightforward. We have an expense, and each different type of property, plant, equipment would have its own account. But I'm just going to put depreciation expense. And then we have that new account, which is a contra asset. It's going to reduce assets. We'll see this when we do the entry. So I'm going to put in just the straight line, and then we'll look at the calculations had it been the other methods. Assets used up always become expenses. Accumulated depreciation, if you set up accumulated, you put something into it, you're actually reducing assets. So why do we use accumulated depreciation, and why don't we just credit the car? It'd be easier. Because in statement readers actually gain something by having, and we can see this over here, they gain something by having the information. What is the cost? What is the accumulated depreciation to date? First year, we don't have too much accumulated depreciation. This was right the first time. And so the book value at this point in time is the difference, or 17,000. So that's information. If we just put down 17,000, you don't know if it's a $100,000 car, if it's almost fully depreciated, or is it a relatively new car. So knowing what new or old your assets are is actually useful information for investors. If they're old, you have to replace them, you may have to borrow money. We may see in the future that our profits aren't as good. Okay, so using up an asset reduces assets from accumulated depreciation. Our depreciation expense reduces retained earnings. We have a reduction to profit because of the expense, and we don't see any impact on cash. Most of your adjusting entries, except the bank reconciliation entries, will not affect cash. Okay. So let's take a look at the other methods. Units of output, and I guess it really doesn't matter which one we take first. But if we fill in the income statement for straight line will show 3,000, and as no surprise, if there's no major change or overhaul, we'll continue to see that. With the other approaches, let me throw that up here too. Got a lot of places I've got the same thing for some reason. Units of output, look at the formula, it's very similar to straight line, but you come up with a rate per mile per hour, and you're not finished yet. So that's why over here you have to actually be told what is the actual mileage for this period. That's where the extra work comes in, and you have to decide cost versus benefit. Is it worth the extra work? So the first part does sound a lot like straight line. Cost minus salvage divided by the useful life, but we're going to go with the useful life. Whoops, kind of got away from me there. 180,000 miles. So this is the activity other than time that we're going to use. So here we're going to deal with, I don't know where my numbers went. Oh, wait a minute. Yeah, I know where I was before. So 20,000 minus 2, which is the salvage, divided by 180,000 miles. And we have a rate. And we put that below there. So what is the actual rate? If we do the calculation for it, we know it, 20,000 minus 2, we've seen that enough times. I'll just put in 18. That's my depreciable cost, the most I can depreciate. I'm going to divide that by the total estimated miles, and you do the best you can. It is certainly an estimate, accounting estimate. So that's 10 cents per mile. Okay, obviously we're not going to debit credit 10 cents, so here's where the usage comes into play. There's no pattern that I can tell you what this is going to turn out to be because it depends on the usage. So if you take, and again I'm sure you can do that, 25,000 times 10 cents per mile, that'd be 2,500 as my amount here. So with straight line we know nothing changes, it's 3,000 every year. With units of output we have no idea what it's going to be until we see what the usage is. So I'm going to put in the cost remains the same whichever method we use. The cost is presented, and then you present the accumulated depreciation separately. So this time we have what? 20,000 minus 2,500 is 17,500. Okay, so you can see the book values can be very different on your financial reports, as well as the depreciation expense for your income statement will be very different. Okay, and then the double declining balance method, which is the one that has the math problem, cost 20,000. We don't have an accumulated depreciation before we depreciate it, so that's going to start out the first year as 0, and then times 2 over the useful life. If you remember, I think the useful life is 6 years. So that's the basic formula, and it'll always be 2/6. Once you got that set up, it doesn't change. So here we're going to do 20,000. Again, no salvage values there. It's a very different thing, and that's why it's got math problems. So 2 divided by, times 2 divided by 6. And of course it's not working out nicely and evenly, so go ahead, always round to the nearest dollar. It implies more accuracy than you have if you do otherwise. So it's all an estimate anyway. You can see with the double declining balance that we clearly have more depreciation. Now that, again, with units of output, it just depends on the usage as to what we're going to have. So if we calculate this, cost minus depreciation, 13,333. I love all the threes. So unless we have a lot of usage here, this double declining balance is probably will take the most depreciation, definitely more than straight line, and it will have the lowest book value. So that, again, if you have a lot of usage in the first years or becomes obsolete quickly, that's a good method. Up here we can see that's a substantially larger number to have. 6667 is a lot more depreciation than straight line. And I'll do my little thing here. I did it. Okay. So we've got all the impacts. So you cannot change methods from year to year. You can see why. The amount of depreciation taken is very different. The income statement has different results. So does the balance sheet. Okay, so that's the first year, and then we went on and we did a few other things like the adjusting entry for insurance. So we paid for 3 years. That was $3,600 was the original thing right here. So I'm looking at, and this was April 1st, so just again, give us a little practice. How many months has it been that we've had this insurance? So if you leave out January, February, and March, that's 3 months. We've had it for 9 months, but it's times 9 months divided by 36 months. So it's 9 divided by 36 because it's a 3-year prepay. So it looks like it's $900 for this period of time. So we'll have insurance expense, again it's an asset used up, 900, and then prepaid insurance goes down. Next year then we'll have a full year, but this time we only have a partial year. Though I don't know what we did the first half, first couple of months, but that's okay, won't worry about that. So your assets go down, retained earnings goes down, profits go down, and no cash. It's an adjusting entry. Okay, and then we paid to replace obsolete or damaged tires rather. Again, this is not a major improvement, just keeping things going in good working condition. So I'm just going to put an expense. Maintenance expense could be appropriate, repair expense, whatever you want to use. Miscellaneous expense. And we've done expenses, so we won't worry about the impact. We know it's a lot of things going down. Okay, the end of the year comes, and for the second year, and we again have to depreciate, and there's no difference in titles that we had before. And I'll just journalize straight line. Okay, straight line is straight line. So this year we've had a full year, $3,000. We don't have to keep repeating the calculations, and why many businesses use straight line. Now the other methods, of course, have to be different. Your units of output, again, we need to know what is the mileage. It's 40,000 miles. We actually used it a lot more in year 2. Hopefully it generated more revenue, and therefore we should expense it more. So 10% of 40,000, I think you would agree, is $4,000. I'll skip the the calculation. So the more that's used, the more depreciation. So in year 2 for the balance sheet, and I needed to track that. Let's do the income statement first. So we have 3,000 depreciation expense. The income statement only goes up for 12 months. And then the units of output, which is actually the last one, is gone up because of extra usage. And then we'll figure this one out in a minute. So if I do my accumulated depreciation, I have 2 years of straight line. I have, because accumulated does increase, it's a permanent account, it's a contra asset. And then the units of output is started with 2,500, and then it went up to 4,000. And then your double declining balance was 6,667. Okay, so that's what we have. So the total for straight line, as we know, is 6,000. This one's 6,500. So I'll put that down there. Again, there's no predictable pattern with this one. So whatever the usage is dictates how much that you've used it. So 20,000 minus 6,500 is 13,500. And we've done the straight line. Let's put the year 2, and we'll get to double declining. If you remember, this is 2 years, is going to simply be 6,000. We saw that a minute ago. Maybe. And as it accumulates, book value goes down, so that's going to be 14,000. Very predictable straight line. Double declining balance, again, is sort of the oddball. So in year 2, we've got $20,000, again, cost, but your accumulated depreciation this time is what you depreciated last year. 6,667 is the amount of depreciation from last year times 2 over 6. So this one definitely has the most complicated of the formulas, but still doable. So the book value is 20,000 minus 6,667, which we did see. Whoops. I lost my calculator. Got a lot of them opened here. All right, we'll just redo that. But you can see the accumulated over here and the book value. So let's just start with the book value since we have that up here already. So, yeah, 13,333 times 2 divided by 6. So that fraction does not change. And now we got a lot of 4s. So we're going to round it to 4444. And I'll put that here. We'll post that up here so we can do the math. Okay, you can see a substantial drop. Each year with double declining balance, it does go down. So our calculation is take the 2 years, add them together, and 7,111 is the double declining balance minus 7,111. That's not right, is it? Let me try that one again. It's 6,667 plus 4,444 is 11s. Okay, I should be able to figure out that. Minus 11,111. Sorry, I clicked on it, but it didn't want to go. Okay, so we can see how very different the methods are in terms of what they give us. Okay, 8889. 8889. So compared to straight line, our book value is much lower. 14,000 versus 8889 is a big difference. And again, the units of output is whatever it comes out to be. Okay, so we have a few more entries. We again do our adjusting entries. And this time we have a full year of insurance to expense. So if you remember, it was $3,600 for 3 years. So I'm just going to divide by 3, $1,200 this year. And we've done the impact on the statement, so we won't do that again. And then the final thing we want to look at is what happens when you do have a major overhaul that changes one of those numbers, either the cost or the accumulated depreciation. If you have a major overhaul, it's actually going to make it, you want to make it look younger. So you're going to have accumulated depreciation being debited for what you spent, which is $2,000, and you've got cash. Okay, we need to look at the impact on the adjusting entry. We're only going to look at the impact on straight line. You really won't have to be adjusting, revising units of output or double declining balance. We figure we'll just hone in on this one. So what's going to happen to your depreciation entry? The titles, of course, are not going to change. Same old there. But what will change is the number. Anytime you change anything like your costs, your salvage, or your useful life, you actually have to revise it. You don't go back to past years. You take the current year and the future year. We call that prospective. Okay, so let's see if we can write this down. I think it might help to do that. So your revised information, basically what you're looking for is the remaining cost divided by the remaining life. Remaining cost divided by remaining life. So what is left to depreciate? You can say cost minus, here you actually want to pick up accumulated depreciation because you've already depreciated that. You don't want to depreciate it again. So in essence, you do want the book value. The book value at that point in time less any salvage value. Minus salvage. Yeah, I was afraid of that. Come up here. Minus salvage. See if it can show up that way. Yeah, that's better. The parentheses is not showing, but who cares? And then we divide by, see if I can underline it. You divide by the remaining life. Okay, so for our purposes, that's going to be 20,000 is the cost, less what has been depreciated. So we can look over here, and we've depreciated $6,000 already. So we aren't going to go back and redo that. We're starting where we are. So we're in year 3. Cost minus accumulated depreciation is the remaining thing to depreciate. We did not change the salvage value. Almost forgot about the salvage. So let me squeeze that guy in. The original salvage, I think, was $2,000. So that's the remaining cost, remaining book value less salvage. And I do need to factor in the fact that accumulated depreciation is not $6,000. Okay, that's why I have this up here. So let me go up here and do it. So if we do the overhaul, again, we spent $2,000. It's right here. And we debited accumulated depreciation. So there's the $2,000. So what's the balance at this point in time? Is obviously $6,000 on the credit minus the 2 gives me a remaining balance. It looks like a 4. I'll just bold it. Okay, so I almost forgot about what we spent. So this really needs to be, and I'll do it up here, 2,000 cost minus the 4,000 that's in accumulated depreciation now, less the 2,000 salvage, divided by the remaining life. Now the life had just gotten changed to a total of 7 years. So if I do 7 years minus year 1 minus year 2, we are actually in year 3. The remaining life, starting with this year, should be 5 years left. Okay, let's see if we can actually do that calculation. And this is the worst part of dealing with this. So we have, 20,000 minus the 4,000 in accumulated depreciation. And that's going to give me 16. 16 minus the salvage. Okay, so that's the cost left to be expensed. We don't expense more than that. We have 5 years left to do it. So I'm going to divide by 5, and that's going to give me $2,800. So if I do $2,800 this year, next year, and the year after for 5 years, that will fully depreciate what I have. And the only difference, had we added something to the asset account where it changed the quality of usage, then instead of 20,000, we would have, something more than that, less depreciation taken to date, less salvage, divided by the remaining useful life. So we can see that by making this change, we do have a change in our pattern. If I add the 2,800 up here, let me take off this for a minute, add the 2,800 and do the calculation, we have 3,000 plus 3,000 plus 2,800 minus 2,000. My math is right, 6,800 would be what goes over here for straight line. And that's different than the pattern would have been, had we just depreciated it with straight line. So we actually have what? Minus 6,800, 13,200. But if you look at this, we have the extra year of depreciation, but there's not as much depreciation taken. So the asset does look younger. It's a smaller percentage of accumulated depreciation taken, and the book value would have dropped much more had we just depreciated the 3,000. So it does impact the book value, and of course the income statement also is impacted because it's only 2,800. It's a little bit less depreciation taken, and we are just going to deal with the first 2 years of the double declining balance, which I forgot to put that one in. So anyway, it's a lot to keep up with. You think about all those assets that these large companies own. So anyway, that concludes our